The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day everyone, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Getting ready for the summer season. We're smack bang in the middle of spring selling season now, and if anyone's who's looking at property at the moment, it's still moving like hotcakes. Market isn't yet slowing down, and a lot of people ask me my views on this and when you're going to start seeing any sort of changes to this current sort of demand or buying cycle. My view is that there is so much sort of pepped up demand in this market right now that you're not going to see it slowing down for a number of months yet. Yes, APRA has jumped in and started intervening structurally in how you can go about getting home loans, but I don't think that's really going to start impacting things for a little bit of time. Yeah, it will do in time. We'll probably have a chat about that today amongst a whole bunch of other things which are lending orientated, and we all know that investing in property is a game of finance, and it's those that best play that game are ready, accessible, have got their money ready to roll, and typically do the best purchasing because they can do it decisively. So if you're thinking about investing in property, I would highly recommend the first thing you need to do is get your finance sorted out. And how do you best get your finance sorted out? Well, guess what? You go and speak to a mortgage broker. They'll help you out. And I'm sure the gentleman that's joining me in the studio will echo those sentiments. Peter White, he's the CEO of the FBAA, which is the Finance Brokers Association of Australia. He's a semi-regular guest on the show. I've known Peter for probably a decade. How you going, Peter? You well?
Yeah, well, thanks, Phil. And you?
Good, mate. So are brokers good or bad, Peter?
Oh, brokers are the best. We all know that. You couldn't expect me to say something else. I'm terribly complete.
Probably the simplest question you're ever going to get in a media interview, Peter. But FBAA, I know about it. Maybe a lot of our listeners don't know about it. I'll just give you a quick sec just to explain what the FBAA does, so people can sort of help frame their chat as we have this next half an hour together.
Sure. Thanks, Phil. So FBAA, Finance Brokers Association of Australia, been going since 1993, is the leading professional industry association body for finance and mortgage brokers. We currently have over 9,400 plus members. We reach and communicate with the entire industry, and there's about 19,000 odd brokers in Australia. It's not mandatory by law to be a member of an association, but it is a sign of your professional status by being so. And mate, myself, I'm been in the game 43 years. I'm also a registered lobbyist in my own right and do a whole host of other things with charities and other small business associations. And we're there to advocate for the industry and to ensure that things that government does or doesn't do, or you tagged about APRA a bit earlier, we'll probably speak on that a bit more, that they understand the impacts of what they're doing. And I was up until, 9 o'clock, I was having a Zoom meeting with a senior federal minister, touching on some of these things that are at risk or potentially at risk when APRA does these things. And they'll make sure they play a balanced scorecard to make sure things don't get out of kilter with what they're trying to achieve. And we know what they're trying to achieve. Markets being heated and people, in extraordinarily low interest rate environments. That's going to change one day. We just got to watch how that plays out.
Yeah, look, I've been sort of quite measured in my commentary around those APRA interventions. When the government, as in the regulator, which is part of the government, needs to step in and do stuff, it means that things are a little bit out of kilter and things need to change. We'll get into that in a moment, but to mortgage brokers, I don't know if you listened to it, Peter, Alex Whitlock, director here at Momentum Media, also he co-invests with me on the Smart Property Investment portfolio, which we share on this particular podcast and on smartpropertyinvestment.com. He had a chat with the Treasurer the other day, and he sort of said to the Treasurer, along the lines of, do you think that the best years of mortgage broking is ahead of us? And Teresa said, yeah, it is. So that's pretty good news when it comes to the government's attitude towards a very important role that mortgage brokers play.
Mate, it is. And I did hear it. And coincidentally, without any pre-scripting or pre-knowledge, I was doing a podcast for somebody else around the same time and said exactly the same thing. Best years are in front of us. It's actually part of my PowerPoint presentations to industry. And the reality is that that's based on my experience in industry. So I've been in this game 43 years.
Yeah.
I've seen the peaks and troughs of markets, both in the real estate sector and the lending sector. And with what's happened in various regulatory environments to the mortgage broking industry, actually sets the industry up for significant success over the coming years. So it's all about that professionalism, that regulatory piece that we've heard about, and I don't know if your listeners have, called the best interest duty, which basically says mortgage brokers act in the best interest of their client. They put the client before themselves. Your bank doesn't do that. I mean, what better step can you take? Say, well, your bank doesn't act in your best interest, but your broker does. And they're forced to, regardless, because of law. And there's like $1 million fine if you don't. So, there's a big stick. And we could turn around as an industry. We've always done that. But there's a greater focus and also a measured understanding now as to what that looks like, which I think is absolutely brilliant. The mortgage brokers originate around 58% or thereabouts of all mortgages in Australia. I seriously believe we're not that far away from that growing to 70 and a potential in the decades to come of 80% of market share because of these regulatory frameworks, and it's all driven by borrowers. It's not like brokers, really feathered their own nest along the way. I set up Rams Home Loans' first sales office in 1993. And in that era, the banks were shutting down branches and it was the borrowers going, hey, somebody come and help me because my bank won't. And it grew from there.
Yeah, and if anyone who's been tuning into this podcast for many years, you'll know that I'm very pro-broker, unashamedly a pro-broker. So I'll just disclose that in the front end. You might think it's some sort of propaganda piece, but you know what? I believe in mortgage brokers. I've used for every home loan I've ever got, I've used a mortgage broker. And Peter, I cannot think of doing it any other way. It would be an absolute nightmare. I'm going through financing right now. I'm happy that I've got a really trusted broker who's leading the way on that. But you speak about best interest duties, Peter, and I was going to talk to you about this. And I don't want to sort of, overcomplicate this discussion for property investors around all these different nuances and stuff. A lot of it is sort of industry speak, but I think it's good to be aware and visible of this. And you were in London with us on that study tour back in 4 years ago. It was about four years ago this week, I think.
Yeah.
And so this was for our listeners. So we had a group of people went out to the UK 4 years ago for a real deep dive look, and they were all mortgage brokers or people connected in with mortgages, a real deep dive look into the mortgage market. We had a number of different sessions for all the big banks and big mortgage brokers out there. And by memory, Peter, they're at sort of market share of 80% and they also, mortgage brokers, pretty much everyone does their insurance through a mortgage broker as well. So that just gives you some insight to how Australia will evolve and develop. And I remember learning out there that pathway for it. When I first sort of got connected in with mortgages as a journo, it'd be sort of 15 plus years ago, I think market share was like 18%. So it just gives you some sense for the consumer demand for mortgage brokers over time. And best interest duties. So I remember back then, 15, 16, 17 years ago, Peter, look, let's be honest, there was a few cowboys knocking around the industry, and there was people like yourself and the FBAA and some other groups who really helped go down a pathway of injecting greater professionalism into the industry. Remember, it's still a relatively new industry. Mortgage broking is not an old one. You need to think back to, even the elections from last time, the debate around mortgage broking, the Royal Commission largely become mortgage broking. Mortgage broking is here to stay. Let's be clear about it. And it's only going to grow and evolve. But best interest duties, I just want to drill down on that. So is this yet in law? It was supposed to be implemented, was it March of next year, or is it actually in place now?
It's in place now as at 1 January of this year. There's a whole lot of little pieces that sit under what we call the NCCPA, the National Consumer Credit Protection Act, which the best interest duty is a part of. And there's a whole lot of little parts that are sitting in there as well that are still playing out into early next year. But the best interest duty is in, and all intensive purposes is working well within the industry and creating the right frameworks for brokers to work within, because I can put it very simply and say the principle of the best interest duty is to put your borrower before yourself. It is more complex than that. When you turn around and say that came out of the Royal Commission and it was one sentence in the Royal Commission, it's about 100 pages of regulation. So, it certainly balloons out somewhere. But, it's a very important piece that, it's always easy to say we've always done this, but it's another thing to prove it. This is all about proving it and making sure there is a consistent standard of expectation as a minimum hurdle. And the hurdle's big to start with, but it sort of starts at a point and goes beyond from there. And, it's nothing that the industry pushed back against. They're fully supporting, embracing it. There's certain pieces of legislation that's proposed that are challenging because you actually can't meet the standards that they put in place, or you agree with what Treasury writes into law, and then our regulator ASIC comes along and writes regulatory guidance that goes beyond that. You say, well, wait a second, we agreed with where the law landed, but you're now saying something different. And last year, Phil, you'll remember the Wagyu and Chirag case with Westpac, where it was all a discussion about household expenditure.
Yeah.
And ASIC said, you're not complying with our guidance. We're suing you in the federal court. Westpac goes along to the court and says, we did what the law said, and then some. Don't give a rat's about your regulatory guidance. That ain't law. So it's an interesting precedence for industry. As long as you've got the bank balance to actually pay for the legal bill, that's another conversation again.
So these are sort of some of the nuances of the evolving third-party mortgage industry. So for simplicity, first party or direct is you go into a bank branch and you're going to get probably given an opportunity to take one of maybe 4 loans, or you go to the third party, you speak to a mortgage broker and you get access to thousands of products. And I would like to think, Peter, this being a podcast for property investors, most of them probably are using mortgage brokers, and we don't need to drill down too much on some of the regulation around it. But the best interest duty, to summarize, is that if your broker says, here are the loans that I suggest you should be taking, he or she should be presenting those loans on the basis that they are right for you and not necessarily right for them, or there's some sort of financial incentive for them to be recommending those products over other ones. Because, and there's so much more oversight and compliance around this right now. If a broker has been found to have not done that, there's consequence for them, right?
Yeah, $1 million fine. But, it's all a part of the due diligence. It's like a fact fine in the planning space. But in lending, it's a credit assessment to really understand what your objectives are, what your financial means are, and to understand what it is you're trying to achieve from the loan product. So there's a lot of due diligence understood to be able to present someone with generally around half a dozen options, talk through the benefits or the pros and cons of those options, to then narrow it down to fine-tune it and say, well, here's what is not unsuitable in today's terminology, but what is in your best interest based on what you want to achieve. And everything's individualised. I mean, don't get me wrong, home loans is not a complex subject, but the borrower's situation is where the complexity is, and understanding exactly what it is that's going to suit that borrower to ensure that they get something that meets the needs of what they're trying to achieve.
Absolutely. But, how we get mortgages is not only changing who does it for us, i.e. mortgage broker, it's how we go about doing it, considering some of the restrictions now underway to try and shape the market. We'll have a chat about that, particularly APRA innovation. We'll just go to a quick break. Back in a moment.
Are you wondering where to buy an investment property right now? Why not let buyers take the guesswork out of it? We can find you the right place on or off market at the right price. An investment professional from our national network of buyers agents can help you save time, money and stress and deliver you a tailored solution. Talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with Peter White, CEO of the FBAA, which is the body that represents and advocates for mortgage brokers in Australia. And they must be doing a pretty good job, seeing market share for mortgage brokers has grown rapidly over the last decade or so. Now, Peter, I've spoken about at length on this podcast and also inside of smartpropertyinvestment.com. We probably need to go too much into the mechanics around it. However, APRA has jumped in and started saying to banks, well, you need to lift the serviceability requirements for some or for all borrowers on the basis of maybe they're borrowing too much money, and when interest rates go up, they might find themselves in trouble. So let's be prudent about it. I think it's a good idea. However, we're seeing a lot of sort of growing interest in investment finance, Peter. And we know last time around when APRA jumped in and got involved in 2017 or thereabouts, one of the focuses was to try and slow down investment lending. So they put caps on how much a bank could grow their investment lending book. And that had a lot of effect. A lot of the argument or discussion was, well, that's nationwide intervention to try and slow down two markets, which was Sydney and Melbourne. They got to do the flag out of it. But you know what? Net result is markets went sideways or went down. And we're seeing now markets recalibrate to catch up on that. Is APRA going to get more involved is the question over this next period of time. They've lifted up serviceability recommendations by 0.5%. Is that going to keep going up? And do you think they're going to jump back in and try and shape investment lending protocols for banks moving forward?
Yeah, hopefully they leave the investment side alone as much as possible. The impact is in residential lending, so there is going to be a collateral impact somewhere. But kind of hope that the 50 basis points moved by APRA on the floor rate is enough. And we really won't know the answer to is there going to be more until we probably get 6 to 12 months down the track to see what's happening in the property price marketplaces. Because we are seeing that prices are certainly selling for more than what they were a handful of months ago. I'm in Brisbane, and we see it up here where prices have gone in 4 to 6 months 30% above what they were back before. So someone's got to rationalise with that. One way to do it is to slow down the ability to borrow. So that you can't borrow as much. You can still borrow, but not quite as much as you could before, which then will hold things back. I mean, to me, it's one of those things whereby the market is changed for good, if I can put it that way, but it doesn't mean it's at the level it is today. So there's probably a rationalisation piece that comes back a little bit from where it is today in certain markets, or certainly not in all markets, but in certain markets that are blistering along a bit, and it'll become a new normal that resets. The thing we've got to watch with APRA is that this is a broad brush approach to servicing a loan. There are impacts, and again, that will affect investors who are doing, developments more so, and they could be small development projects for the first home buyer market, who all of a sudden, may not meet the new serviceability regime. People buying off the plan when the reassessment's done prior to settlement, all of a sudden may not be able to afford. I'm actually right now in the middle of a whole pile of research that's actually sitting right in front of me, papers to politicians and regulators, conversations last night with the senior minister as well as a couple of weeks ago around the fact that we've got to watch how this plays out. We understand and don't necessarily disagree with a part of this move. We don't want to see what happened as a part of history when APRA moved floor rates back in the day, and that had quite a disastrous effect. And one of those effects is people become mortgage prisoners. So you get investors sort of going, well, geez, I can now get a better deal as rates start to move around a bit, but you can't move your loan because you don't meet the new servicing floor rates. You financially are probably paying more than what you were before. So we've got to watch this mortgage prisoner game. We've got to watch what happens with the first home buyer market and also the refinance market. But it's one of those things that it's a delicate step and one that can have unintended consequences and landmines pop up that wasn't the intent of what was trying to be done.
Yeah. And what's your take on generally the market at the moment and this buyer frenzy? And, the logic being supply and demand. There's more people that want to buy properties than what there is properties for sale. Therefore, what happens is that prices go north and that recalibrates expectations around what you need to spend, which largely for many people is out of their ability to borrow. So eventually the natural market should put a cap on it and it should slow itself down. Do you think the APRA intervention was required?
I think so just now, but what you said is exactly right. I was speaking with a property expert last week on my Q&A with Whitey, similar sort of thing, but not a podcast. And we're talking around this. But one of the things that needs to happen in today's environment, because of the uniqueness of today's environment brought upon us by COVID, where an example for Queensland is the migration north, which is a normal process of everyday life. People sell up down south where the property prices are higher, buy up in Queensland because the prices are cheaper. That is normal, has been going on for decades. There's nothing new on that, except during COVID, that purchase and that desire to move has heightened. So what's happening is now, the prices in Queensland are artificially inflated because of this heightened demand to drive. Once that cools, so once the borders are open, once international travel starts to come back on and everything starts to rationalise back into a normal world, because Queensland is largely a tourist destination, so we're used to having this mix in the pot that disappeared, then it will start to rationalise back by its own natural course and say, well, this is the new level. And I'm not saying it is where it is today. I'm not saying where it is in the past, but there'll be a new level that will naturally find its own footing. And that's why we can't have APRA going too far on what they're doing. I understand it's a little bit of a reaction of today's market, but that's why I kind of hope that the borders open, that rationalisation starts to play out, normal transitory movements just flow around the country, which they haven't done now for, March will be 2 years.
Yeah.
But it hasn't happened. So we need to get past all that and get back into a normal market phase.
Who tells APRA what to do?
APRA, they're an independent regulatory body. Government has oversight, so it does fall into Josh Frydenberg's portfolio, so does ASIC. But from a political environment, all regulators, but if you're talking APRA and ASIC as two at hand, have independent decision-making powers. Same with the Reserve Bank, not meant to be influenced by politicians for all the reasons you possibly could think of as to why you don't want politicians influencing outcomes. But sometimes it plays against you because the regulator gets too heavy-handed, too much of a beat up.
So the question is, who polices APRA? Who actually says, APRA, mate, that's too much. You got to slow down.
Well,
take it
a
easy.
conversation to be had with the Treasurer.
Yeah, okay.
And it would be a negotiated conversation, I would imagine. The Treasurer may contradict me on that, but it is very deliberately built so that politicians cannot bully, manhandle, whatever thing you want to call it, a regulator to tell them what to do. But there are certain conversations I would imagine that would happen around the impact on economies, markets in various states, nationally, federally, globally, and the way IMF looks at us and the International Bank, the World Bank. All these things would have an impact as to how those conversations would play out. They're fairly complex, as you can imagine, but it doesn't take blind Freddy to see that if you're going to screw an economy, what the outcome of that looks like.
I like to think there's some pretty big brains sitting inside these regulators, these boffins who sort of come up with this sort of intervention. And look, it is complicated. Like, we need to acknowledge it. It's complicated. It's macro and micro finances, what's going globally, all this sort of stuff. To actually jump in and make these decisions, I would no doubt think is very considered. But it's the obligation of the lenders to oblige themselves to the recommendations that come out of regulators like APRA. They can't go, I'm not doing that.
Well, with APRA, they can't say no. They're obligated by law. The thing that needs to play out in a lot of regulatory space is the pub test. Does it actually make sense what you're saying? Have you looked at the unintended consequences? Like I was talking about APRA, you look back at what happened in the past when floor rates moved. You think about the impact of people buying off the plan. They've got an approval in principle that was based on one set of servicing criteria. That benchmark has moved up. And if they were close to the border, all of a sudden they think they're buying something that they can't. Has that been looked at, and to what degree? Because there's no commentary around that. And unfortunately, it's one thing to be, it's actually part of my conversations I have with politicians, because one of the key things I do is the lobbying for the industry, is that don't talk to me as a theorist. I'm not a theorist. I'm a 43-year practitioner. And you've got to balance the conversation between theory and practical outcomes. And sometimes the practitioner piece isn't asked for, isn't heard, or just doesn't get played out. And that's where I've seen over all these decades where things go left of centre. So kind of hope that pub test piece plays out.
And do the banks like sort of being told what to do by APRA? And I imagine they go, yes, Mr. APRA, no problems, 3 bags 4, but they can still tinker with policy to still make lending an attractive proposition. And let's be clear to our listeners, like, when a bank says, no, I don't want to lend you money, it's because you probably don't meet their servicing requirements or whatever the criteria is. Banks are in the business of lending money because by lending money, they make money that they give back to their shareholders. And most of us are shareholders either direct in banks or via our superannuation funds. So we're all highly invested in that journey. So banks want to lend money. So banks have different things they can do in order to still service the needs of property investors, right?
Yeah, exactly. It's like they don't make money out of deposits, because deposits historically and still today was what funded loans. So that's why when you look at how much you get on your money when you put in the bank, 2/5 of bugger all at the moment.
Yeah.
Because the lending rates are 2/5 of bugger all. So, it's the lending, as you aptly point out, is where they all make their money. And of course, we've got certain lenders in today's world who only do lending. They don't take deposits. So if you don't lend, you're basically facing a very dark barrel in front of your eyes. It's going to shoot you in the head. But they have to work within the rules because there's many eyes, not just regulatory eyes, there's consumer advocates and God knows who else looking at how they lend and are they lending responsibly and not putting people into debt that they shouldn't have and all that sort of stuff. So
and that's a really important point, Peter, and I'm happy you brought it up. We'll get into it. We'll just go to another break. Stay with us, back in a moment.
Do you want to achieve wealth and passive income through property investing? PK Gupta helps a community of over 10,000 investors achieve passive income by buying top 5% growth and simultaneously positive cash flow property using data, without wasting months doing research, spending weekends at inspections, or dropping $15,000 on buyer's agents each time. So if you're overwhelmed with information overload but don't want to drop $15,000 on buyer's agents each time, check out PK's website, consultingbypk.com.au, and learn to build passive income through data.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Peter White from the FBAA. Now, Peter, before the break, you mentioned responsible lending, and brokers now have best interest duty, so they've got to make sure they put you into the right loan for your circumstances. To that end, if you're a consumer and you're working with a mortgage broker, give them all your information. Don't give them fake information. Don't give them fraudulent information. Tell them exactly what's going on. And if you do that, they could probably go about doing their job as effectively as possible. That's right. A point. There's still a bit of fraud in mortgages, a lot of it perpetrated from the borrowers themselves. So make sure you do it the right way. Now, mortgage brokers are doing what they're doing. Banks, responsible lending. Banks don't want to be put in, let's be clear, banks don't want people to be taking on debt that they can't repay, because that is bad for banks, right? If people can't pay it, that means you've got to sell the house and it all gets really messy for everyone. And banks normally give a fair bit of sort of flexibility, before foreclosure. They'll give you a fair bit of flexibility to make sure you can either sort yourself out and pay down the debt or whatever else. If they foreclose and they just sell it, that's when things go really, really wrong. So let's be clear on that. However, my point, Peter, and your view, the responsibility for taking on debt starts and ends with the borrower.
Correct. So borrowers are accountable for the information they give. They're not solely, but so responsible lending is really all about the bank's credit policy. So when you go to a broker or if you deal through a bank and they said, you got to give me this, and this, and they give you a whole list of things they want, that's really so that they can check off and ensure that they're meeting their responsible lending obligations. And it's been there almost since year dot. But the accountability falls back to the person giving the information. So, look, in the past, there's been some bad brokers that have committed fraud and so on, and we've weeded the vast, vast majority, and that sort of play out of the industry with tweaks on regulation. So at the moment, the borrower is also highly responsible. So if you give us fraudulent information, then you've committed fraud, quite simply. If it's not true, it's false, and therefore you're the one who's putting your noose in your head in a noose at the same time. And it's just not worth it, because no lender, bank or otherwise, but no lender lends you money with the intent never to get it back. It's a fundamental principle in lending. They expect that you will repay it. Now, even if it's an asset finance loan where there's no financial statements, it's based on you're going to sell this property or you've got this super, you've got a means to clear the debt somehow. And if you can't, then that serves no purpose to anyone, especially from a bank's point of view, because their bad debts that they accrue on their balance sheet has an impact on their capital requirements under APRA regulation. So it actually hurts them to have out of control bad debt. So it doesn't, nobody wins out of it. And the best experience you'll have is by telling the truth and dealing with where that truth lies. And as an investor, you might want to buy a $2 million property, but it might be 1.5 because that's the reality of where it lands. Well, you're better off to do that and have a really happy journey with it than to do something that's going to cause you a nightmare. Because even though, Phil, what you said is right, the banks give a fair bit of leeway through hardship provisions if things go south. But once that runs out, it gets dark really quickly.
Yeah. Yeah, it does. And a lot of people do blow their dough and they end up in bankruptcy as a result of this sort of stuff. So the thing is, don't borrow beyond your means. Calibrate your ability to purchase. And the first home you buy doesn't necessarily need to be the home you or the property you have forever. That's more owner-occupier. But one of the things that we chat a lot about on this podcast, Peter, is this notion of, hey, rent where you want to live and invest where it makes sense to invest. And if you think about being a proper investor in Sydney, if the median price is $1 million, guess what? That's going to price a lot of punters out of the game. However, you can invest in properties in other capital cities for $300,000-400,000. Like maybe that's the option. I know a lot of investors, and I've had them on the show, investing in Perth right now, picking up stuff at sort of $200,000-300,000, and they're good investments at the start of their investment journey. They're young. In 20 years' time, they might be able to do something else. So you've got to borrow and you've got to buy within your means as a property investor. What needs to happen, do you think, Peter, to improve the investor-broker relationship? What's your thoughts? Is it working pretty well at the moment, or what would you like to see? What do you think mortgage brokers can do more? What can the sector do more, do you think, to support property investors?
Yeah, I think the market's doing well, but I think it's still a long way from where it could be. So we spoke earlier about what happens in other countries, where we are today in Australia, and where I believe that the originated loans can reach for mortgage brokers up around the 70 to 80% mark. And I guess mortgage brokers are learning to be a lot more aware of what's in front of them. I think historically brokers weren't. So somebody says, I want a home loan. So you go there and you do a home loan without doing a broader analysis of, do they need a vehicle for leasing? Do they need an overdraft for business? Are they looking at rental investment properties and so on? This is where the best interest duty is actually quite a help, because it makes you explore that due diligence piece further and understand exactly what your borrower is doing, not just today and not necessarily in the next year, but over the next 5 or 10 years to get an idea of what their plans are. And I think, brokers need to be more aware and looking at that due diligence and looking to try and help borrowers in a more effective manner in the investment marketplace. And investors need to be receptive to going to a broker. I mean, we know it still is the vast majority, but there's a lot of people that don't. And I would strongly encourage it, even just from an investigative point of view, get a broker to do some research for you and prove the fact they're worthy of your business. I
completely agree. Go and check it out. If you're not using a broker, do it. I'll close with this question, Peter. And I remember you actually spoke at a function done by Momentum. There was a report done a couple of years ago during the Royal Commission. It was called Consumer Access to Mortgages Report, which pretty much said, I can't remember exactly the numbers, but 95+% of people who have used a mortgage broker were happy with the service provided by a mortgage broker. Fact, during that point in time around the Royal Commission, it was around, well, would you pay a service to get that same? Would you pay a fee to get that same service from a mortgage broker if that mortgage broker wasn't paid a different way? And most people said no. Where do you think it is, and when do you think we're going to get to the point where investors will start paying a fee to the broker for going above and beyond and working through? Like I think of myself as a property investor, mate, I'm hard work. Like if you're a mortgage broker, you don't want me as a client, right? Like I'm really, really hard work because I've got a lot of loans and a lot of properties, and I call it sophisticated corporate structure. I'm hard work. You got to do 4 times as much work for the same return. I would be happy to pay a fee. Like if a broker said to me, Phil, it's $1,500 for me to do this, mate, plus however else they're paid, I'd go, yeah, no worries, thanks. Take the headlock off my hand. When's this going to be the norm? Well,
I don't know if it will be honest with you. And talking about that research in the past, the FBAA has just been completed a whole lot of independent research of our own leading up to a legislative piece for next year, but it talks a bit about that. So out of the people that got surveyed, 98% of people said they'd use the same broker again. So those that used a broker said that 98% would use the same broker again.
That's good.
98.3% said that they would just use any mortgage broker for a future home loan. So regardless of it was the same or not. And again, these are not plan numbers, this is pure data, just the way it landed, 98.3% said they believe their broker acted in their best interests. This is important for investors. So we have confidence in the fact that this is actually playing out. And 94% had no problem that a broker gets paid a commission by the lender. Now, it doesn't impact the interest rate a borrower pays. You go into a bank branch, it's the same rate as if you go into a broker. It's a cost of distribution. It's not an increased cost. In actual fact, brokers are ones that keep the pressure on competition, which actually keeps the margins low. But yeah, for me, I think it's a much better world whereby the banks remunerate. They need to distribute product. We are the distribution point, and therefore that should be compensated appropriately. You made a comment about banks earlier. Have you walked into a bank branch lately? There's no one there, just a whole lot of plastic screens. Go, shit, where is everybody?
You know what? I was going to mention that, Peter, because, and you're talking about distribution, right? Okay, so a mortgage is a product, and let's get clinical with it. A mortgage is a product that people need. How do you get that product into the hands of the people that need it? If you want to buy a loaf of bread, you go to a 7-Eleven or your service station or the shopping centre, you go to Woolworths or Coles. They're distribution outlets for that loaf of bread. At the moment, how do you get a mortgage? You either go into your bank branch or you go and see a mortgage broker. There's two different ways: third-party distribution, first-party distribution. Peter, to your point, mate, I can't find a bank anymore. and I'm in North Sydney. I can't find a bank. I go, I need to go to Commonwealth Bank. There's one down there on Walker Street, closed. I want to go to St. George, closed. They're all closed, mate, and they're never going to open again. COVID was the bank's chance to actually get rid of what is a more expensive distribution channel, and that is bank branches, than what there is a mortgage broker. So hence the reason why, that's a great tailwind behind mortgages to get to 70, 80% of it. But that said, Peter, I cannot think of walking into a bank branch and say, hello, Mr. or Mrs. Teller, can I have a home loan, please? I just couldn't fathom it, mate. And I think it's antiquated. On the same Walker Street, we make a joke out of it. There's a Kodak sign there. And we go, oh, look at that. That's a museum.
Yeah, who buys a camera?
Bank branches, I put it out there, they're museum pieces. No one's going to go to bank branches anymore. I said it, Peter, you didn't have to.
Fair enough. Yeah, you beat me. Right. It's quite a different world, and how it's interesting how quickly that's changed. And like I say, I'm with you. I've only had to go into a bank branch of recently to do some stuff for the association here, and I had the same problem. I couldn't find one that was open. I used the mapping system on the car and the internet. Here's a branch, click there. Oh, closed. No, they don't do anything. It's just an admin hole. There's no transactioning or anything. You say, oh, geez, you're certainly not helping yourselves out anywhere.
No. Well, the thing is also, and this has changed, maybe you can speak to it very quickly just to close with, Peter. Before COVID-19 coronavirus pandemic hit, in order to get a home loan through a mortgage broker, they had to sit down with you and eyeball you and say, yes, you are Mr. Tarrant, show me your ID. Yeah. That's changed. That technology has existed for years. It's just taken COVID to enable change in how that bit of the process was done.
Correct.
That's completely changed the game.
Yeah, it certainly has. Hey, Phil, I know you're going to finish up shortly. Can I just add one piece for investors?
Yeah, sure. Absolutely.
Part of this research that we did was also on what we call the Australian mortgage and rental affordability, right? And we had McCrindle do the research as an independent body. And what it showed, the critical thing to me, what it showed is that people who are paying a mortgage and people who are paying rent cannot afford an increase of $300 a month. And actually 57.5% of people cannot afford a $300 a month increase in their rent or a 1% increase on the average home loan. And it was 47% could not afford a $200, so $50 a week increase. The thing we've got to watch when interest rates move, and they will move. You can see the banks upping their fixed rates. They're planning on rates are moving in the future, right? And that future may be closer than what we think and be out of step with what anything the RBA does from a cash rate point of view. But when that happens, what we've got to watch as investors and people who are borrowing money is that there is a tolerance there that snaps the swing if we're not careful with hardship and people just not being able to do or to meet the repayments that they've already pre-agreed to. And with APRA moving the floor rates, it will be difficult for people to refinance to get a cheaper rate, right? We've got to watch how all this plays out. And I think it's something that I would ask landlords and investors to be sensitive in their planning to watch how that plays out. It's not today. I know it's not today, but if you're looking at a 3-5 year strategy on buying a property and flicking it, or a longer term portfolio investment for 10 years, need to watch how these things play out. Just as a caveat emptor, if we're lucky, it'll play out fine. But we do know the tolerance for me, and I've been in this industry 43 years, that tolerance is a lot less than what I expect it to be. And that's coming from dual income people who have 2 incomes into their homes. So just need to watch that. Don't want to finish on a negative note, mind you, because the market's really great.
But to that point, Peter, the market is the market, and there's always discussion around. Well, in certain suburbs, it's cheaper to own than to rent, and in other suburbs, it's cheaper to rent than to own. This is just market dynamics. So you're going to find some places where first-home buyers who were thinking they were saving up their money, they were renting, saving their money to buy in that suburb. Guess what? They might not be able to buy in that suburb anymore because of these APRA requirements. Therefore, they might rent longer, which means that's good for investors. The other side is that if that investor ratchets their rate up too much in terms of that rent, those renters are going to go, stuff it, I'm done. Let's get out of here and live with mum and dad for a year so we can actually get where we need to be. So the market will sort itself out, but you do need that sensitivity. That's good analysis, Peter.
And at the end of the day, it plays back to why you need good research. Speak to the professional people, give research on property, and speak to a broker and give you the right research on the right sort of loan and what you're trying to achieve.
So hypothetically, if I don't have a mortgage broker, can I go to the FBAA and find one?
Certainly can. Off our website, there is a find a broker function, so you can find a broker in your area.
Okay, FBAA.com.au. All right, well, if you don't have a broker, I reckon you should definitely check it out. And the FBAA has been around for a long time, and it's where the best brokers live and where they keep their membership. So thanks, Peter, for your time today. I've really enjoyed it.
Thanks, Phil. Appreciate it. It's great as always.
Nice one. Go and check it out, fbaa.com.au. Go and have a look at smartpropertyinvestment.com.au. We've been chatting about this quite a lot lately, APRA stuff. Get connected. You know what? Your mind's going to boggle. Guess who can help you out with this? Your mortgage broker. Ask them about it. They'll tell you what you can borrow pretty quickly. Social media, Smart Property HQ. Favour for me, and no doubt Peter White's just about to do this. He's going to pick up his Apple telephone and leave a review on Smart Property Investment. It's where it helps us keep growing the community. And I get to do the best bit of this job, and that's talking behind a microphone. But I've got a real talented team here who are passionate about making this good, and they get a real kick out of those positive reviews coming back. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.